Hey everybody, it's Josh Itzo from Greenspring Advisors. I'm a partner and managing director at Greenspring, and we are the retirement plan advisor to your company's retirement plan. And I wanted to take a few minutes to talk about ideas and thoughts on how to maintain perspective in volatile markets. Obviously, the past few weeks have been really difficult in the stock markets, most importantly because of the concern around the coronavirus and the impact that is potentially going to have, obviously, in our country, and how that could impact, the people that we care about and our loved ones, and our day-to-day lives. And first and foremost, that's the most important thing to be concerned about. And I think if you talk to most people, that is where their primary focus is. But obviously, that uncertainty and that fear has had an impact on the stock market, and obviously people's money and their retirement savings. And when you add in things like the price war that's impacting the price of oil between Saudi Arabia and Russia, we have what feels like in some ways this perfect storm that's brewing. And again, it's throwing the market into disarray. The market really doesn't care about the human condition or the human element. What the market likes is certainty. And when there's uncertainty, it obviously throws things into disarray. It creates lots of volatility. And my main goal over the next maybe 10 or 15 minutes is just to talk about some things and put some things in perspective in terms of helping you be aware, but also be able to control your thoughts and your feelings, and ultimately your behaviors, so that your mind doesn't sabotage your money and cause you to make decisions that could be detrimental to you over the long term. I think one of the most important things to recognize is that our brains are not wired in a way to help us make good financial decisions when we are in periods of high stress or high anxiety. And many people struggle to control their emotions and their feelings, and the very visceral impact these fears have on us in periods of high volatility with the stock market. And so people get whipsawed and they go on this roller coaster ride of optimism, and then people get really excited, and there's elation when the market continues to hit new highs. But then at some point, as markets always do, when they turn and they go through periods of volatility, in some cases pretty extreme volatility, and when that volatility is swift, like we've seen over the past few weeks, people go from nervousness to outright fear and panic, and then ultimately the market turns around, and the cycle starts again. And I think the most important thing, and what I want to get across today, and with some of the information that I'm going to share with you, is that on that downslope, when it's going through nervousness to fear and panic, is to be very careful about taking and be very cognizant of the fact that you need to be able to kind of take a step back, take a deep breath, and really consider the impact of any decisions you make in the short term and how those could impact you over the long term. I want to provide some information to you, hopefully that will be helpful, some evidence, some data. I think it's really important in periods like this, not just to think about what's happened in the past day or the past week or the past couple of weeks, but to maintain more of a long-term historic perspective. And so what you see here is various bear markets and corrections over the past 20 years. And so in the top chart, what you can see is the S&P 500, which is the index. Basically, that's roughly the 500 largest companies in the United States that are publicly traded. You can see in the light blue is covered by the time period in a bear market, and that is when the market has gone down at least 20%. And then the orange are periods of correction, and that's when the market has gone down at least 10%. And so I want to point out a couple of things. One, going back over the past 20 years, you can see a lot of different events. In fact, in this case, there's eight different events that we see outlined here. Whether it was the tech bubble crash in the early 2000s, whether it was the pre-Iraq war, also in the early 2000s, we had the global financial crisis that many of us remember. In the latter half of the first decade, a few years ago, there were issues around the slowdown or projected slowdown of growth in China. There was a correction in early 2018. There was a major sell-off where equity markets were down somewhere between 10 and 15% in the fourth quarter of 2008. So I think that the key takeaway here is to recognize that corrections and bear markets and periods of volatility are natural and they're normal. If you go back over the last 50 years or so, the stock market has gone up just about 3 out of every 4 years, but that is not linear. So it's not 3 years up and then 1 year that goes down. If you look at the tech bubble crash, that was about 2.5 years of sustained down markets from kind of peak to trough. But these situations and what we're going through right now from a financial standpoint, not from a medical standpoint with this pandemic that the world is dealing with, but from a financial standpoint, these types of things happen on a very regular basis. In 3 to 5 years, I suspect that we won't be talking about the coronavirus. But we will be talking about something else because markets go up and markets go down and they go through periods of difficulty and they do it on a pretty regular basis. If you look at the bottom part of the chart, I want to point out a couple of things just to put it in context. If you look at the duration of these, the average duration or how long each of these, the average length of these 8 difficult time periods, it worked out to about 8.5 months or so. So you can see that lasted pretty short from a couple of weeks all the way to 2.5 years from peak to trough with the tech bubble in the early 2000s. If you look at the average percentage drop in the S&P 500, and again this is just looking at the S&P 500, but if you look at the average drop, it was about 25%. If you extrapolate that over the 8 different events. And again, that could range from anywhere from, you can see here, from down about 10% all the way to almost 57% with the global financial crisis. If you look at the recovery period, so again, that is from trough back to what the peak value was right prior to the pullback or the correction or the bear market, it averaged about a year and a half, about 16 to 17 months. But I think what's really illustrative and important to think about is what did returns do after the bottom was hit? And obviously, nobody knows when the bottom of the market is going to be hit. We don't have any idea. I couldn't tell you what it's going to look like with the current environment that we're in. My crystal ball is just as fuzzy as yours is. If you look at the financial crisis, it really started at the beginning of October, and March 5th, so it was about a 6-month period, but March 5th, 2009 was the trough. That was the bottom. And from that point on, the market recovered, and it recovered significantly in a pretty short period of time. But if you look on average, the percentage gain after hitting the bottom over 1, 3, and 5 years, you can see the numbers are really significant. So on average, in these 8 periods, 1 year after the bottom was hit, the market had gone up by 34%. In total. If you go 3 years out for the periods that are available, you see that the S&P 500 had recovered and gone up by 50% from the bottom. And over 5 years, the average was 68%. And again, you can see, generally speaking, the greater the crash, the greater the recovery over 1, 3, and 5 year periods. So key takeaways here is that things like what we're going through right now are normal. And that generally speaking, when the bottom is hit, and none of us know when that's going to be, but markets are very resilient and they tend to recover very quickly and very substantially, over the 1, 3, and 5 year periods after the bottom is hit. I think this is another reason, and our advice is in times like this, in many cases, the best thing to do is to do nothing, is to stay invested, to recognize that markets are going to go up and they're going to go down. Most people have a very long time horizon. It's not, 1 year or 3 years or 5 years, even if you're close to retirement, because of life expectancies. Many people have, anywhere from probably a 10 to call it 30 or 40 year time horizon that their money's going to have to last. So really, when you start thinking about investing, it's not to the day that you're going to retire, but it is, to the day that, quite frankly, that you're going to die. That is your time horizon. Obviously, nobody knows when that's going to be, but life expectancies are increasing. I recently saw a statistic that the average married couple age 65, there's a 25% probability one of the spouses will live to be 95. So if you think about if you retire at 65 and one spouse lives to be 95, that's a 30-year time horizon from the day that you retire. So that is hopefully helpful in keeping a longer-term perspective. What I would tell you is if you need money or you need your money in the next 3 years, or in some cases maybe even 5 years, you probably shouldn't have it invested heavily in the stock market. This is an interesting chart here. It shows a hypothetical investor who had $100,000 invested in the S&P 500 and how that $100,000 would have performed over the 20-year period from January 1, 2000 to December 31st, 2019 if you missed the either 10 or 25 best performing days during that entire period. So what you can see is somebody who was invested over the entire period, that $100,000 more than tripled and grew to $324,000, but just missing the 10 best days over that 20-year period. So the single best day on average every other year, you saw that the account balance was cut in half. The return, you still made money, but you made about $161,000 or $162,000 instead of twice that amount by staying invested over the entire period. And if you miss the top 25 days, so on average, call it the top 1 or 1.5 days per year, you actually lost money over the 20-year period. That $100,000 actually decreased to $82,000. And I think this is really important to keep in mind, is that staying invested is kind of the cost of admission when you, or volatility is and market declines are part of the kind of price of admission to be able to invest over time. But markets are resilient over long periods of time. They do provide very attractive returns. They help you, have historically helped investors achieve significantly more in earnings and in money than if you would have just left your money in things like cash, which feels a lot safer, but actually can have a really detrimental impact on your purchasing power over time. So this is a great kind of case in point of why it's important to stay invested. The reality is nobody has a crystal ball. Nobody knows what the 10 or 25 best investing days are over a 25-year period. And if you do get out of the market, you don't stay invested, you're much more likely to have an unsuccessful investment experience. When you get out of the market, you actually have to get 2 questions right. It's easy to know when to get out, but the real challenge is when to get back in. And the vast majority of people are very unsuccessful at doing that. I do think it's just important to keep a long-term perspective when you do look at how markets have provided just pretty incredible returns over time. In the short term, markets can be terrifying, but in the long term, returns are really terrific over time and have been historically. If you go back, again, 20 years to December 1999 through December 2019, what you see is a comparison of a $10,000 investment in different types of investments. So $10,000 invested 20 years ago in cash would have grown to about $14,000. $10,000 invested in bonds would have grown to more than $26,000. $10,000 invested 100% in stocks would have grown to more than $32,000. And what's really interesting over this period of time, and every period of time is different, but over the past 20 years, a portfolio of 60% stocks and 40% bonds would have more than tripled as well and been close to $32,000. Actually, a 60-40 portfolio would have returned almost as much as 100% in stocks over that period of time. And what you can see is with a smoother ride during that period of time. So again, market returns over time have provided substantial returns that have allowed investors to earn far more than inflation and maintain purchasing power. This is true going back, 80 plus, 90 plus years to the 1920s, and even the past 20 years. But what you can see is there is volatility, there are ups and downs, and the important thing is being able to control your emotions, control your behaviors, and stay invested during those times. I do think the outcome of holding stocks, when you look at the data over the long term, is very attractive. And so this looks at the S&P 500 index at the end of 2019, and it goes all the way back to 1970. And if you look at the light-colored blue bars, that shows the returns of the S&P 500 year to year. And so what you can see over that nearly 50-year period is that there were there were 9 or 10 years where the market was down. The rest of the years, the market was up. Sometimes it was up a little, sometimes it was up, a lot, close to 40%. But the dark blue bar or line is actually, I think, really important to take a look at, and that is the rolling 20-year returns of the S&P 500 index. And what you can see is over that, call it 50-year period, is that the S&P 500 index over rolling 20-year periods was never negative. Returns were always somewhere between, call it, 5% up to close to 20%. And that just illustrates the durability and the strength of investing in the stock market and staying invested over long periods of time. Year to year, there's going to be a lot of volatility, but the longer you stay invested, the longer you invest for, one, the more money that you make, and two, what we've seen, again, in the past, there's no guarantee of future results, but if you look at history, what you see is over rolling 20-year periods, markets have not been shown to be negative. So historically, you're gonna make money if you can stay invested over a 20-year period. I also want to talk about just the high cost of cashing out. As I mentioned, you got to get two decisions right: when to get out, but more importantly, when to get back in. The first one's easy. The second one is a lot harder, and it can really sabotage your overall experience over time. And so what this page right here looks at is it takes a look at two hypothetical investors over, again, a 20-year period beginning in 2000 and going through 2019. And what you see is these two investors both began in 2000 investing $2,000 each quarter to their investment accounts. Now, the steady investor, which is the bright blue bars in the chart, kept her money and ongoing contributions invested, riding out the ups and downs of the stock market. And the anxious investor, which you see in dark blue, moved his account balance and contributions to cash whenever stocks dropped 10% or more in a quarter, and then only jumped back into equities after 4 consecutive quarters of positive returns, right? So it's getting kind of both those decisions, when to get out and when to get back in. And this behavior of this hypothetical investor was repeated over several market cycles that you can see there. Again, tech bubble, global financial crisis, the flash crash in 2010, and so on and so forth. And so while both investors saw their portfolio balances decline during downturns, they continued to contribute to their accounts. The steady investor took advantage of lower stock prices through her ongoing contributions, so dollar cost averaging, and she was rewarded as the market recovered. Ultimately, the anxious investor, though, by getting in and getting out, their account only grew to about $181,000, and that was less than half of the steady long-term investor's account, which grew to nearly $500,000 at the end of that period. And so, I do think this is really important. Some of you may be thinking about cashing out right now. I would tell you that that is in the short term may feel great, but over time there's a high probability that that's going to have a detrimental impact on your investment experience, which will ultimately translate into a suboptimal retirement experience. So as difficult as it is, I think it's really important to maintain your mindset, control your thoughts, control your behaviors, and really focus on the things that you can control. And that's really kind of my last, I'd call it 5 bullet points in my suggestions in terms of how to have a successful experience. It is to focus on your behaviors so that they don't sabotage your decision making. And number 1 is making sure that you have an investment plan that fits your needs and your risk tolerance. Number 2 is making sure you structure your portfolio along the dimensions of expected return. So, how is your portfolio, what percentage is invested in things like stocks that are going to be more risky but also provide higher returns over time versus bonds? That's going to have a huge impact in terms of what your overall experience looks like. Number 3 is to diversify globally. In the plans that in your plan, you have a lot of options to be able to invest not just in the United States, but to invest internationally as well, which is I think a really important thing to do. If you look back to 1970, in rolling 5-year periods, the U.S. and international markets outperform each other on basically a 50-50 basis, somewhere around there. So you'll get a period or a couple of periods where the U.S. will outperform and then they'll underperform international markets. Important to diversify globally. Manage your expenses, manage how much you're buying and selling. If you have taxable money, manage taxes. You can't, if you can control those things, you can keep a lot more of what you earn if you're disciplined about doing that. And then lastly is just to stay disciplined through market dips and swings. One of the nice things about a 401k plan or a 403b plan is every pay period money is going into the account. So when markets are up, you're buying shares that are at a higher price. When markets are going down like now, you're actually buying more shares at a lower price, and that dollar cost averaging over time can be really helpful for you. And then lastly, we are here to help. We are a fiduciary advisor to your plan, which means that we are legally bound to give you advice that's in your best interests. We don't have conflicts of interest. We don't sell products. You know that however we advise you, whatever we recommend to you is going to be in your best interest, and we don't have any conflicts that could impair our judgment. So you're getting somebody who's on your team, on your side. We have a great digital platform called Clarity at Work that you can visit, www.greenspringadvice.com. We have a lot of things that we think are going to help your experience. Number 1, we provide access to a really powerful digital financial planning tool called Right Capital that is free to you. It can help you do comprehensive and robust retirement projections. It's got a budgeting tool. It's got a debt management tool to help you get out of debt and come up with a strategy to get out of debt more quickly. Most importantly, we provide on-demand counseling and advice from a certified financial planner that you can sign up for a one-to-one with. You can set up a call. You can set up a web conference. Again, credentialed, qualified, and experienced, that's going to be able to give you objective advice. And then lastly, we've got over 200 pieces of content, things like articles and posts and webinars that can help you increase your knowledge, increase your financial literacy. If you have questions, get access to that. So go to www.greenspringadvice.com. You have the ability to sign up. Make sure you sign up with your company email address. And when you do that, you can schedule a one-to-one and make sure that if you need help, if you want somebody to talk to, if you want to get a second opinion, if you have questions, we are here to help you. So it's a difficult time. We obviously are most concerned, like you are, about the kind of ramifications just from the impact on humanity when it comes to the coronavirus. And that's our first concern, like it is for you as well. And so we would encourage you to be safe and to take necessary precautions. But as it relates to your investments or your finances or your retirement, take a step back, take a deep breath, and really make sure you're focusing on not letting your mind sabotage your money. And if you need help, reach out to us. We're here to help you. Thanks, and stay strong.